week's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on your cash flow problems so you can build things that matter. All right, this week's topic is going to be preparing for tax season. We want you to do that with confidence. So let's talk a little bit about tax. And I know this tends to be, this is a topic that we talk about a lot, especially all through the year. But as we get closer to a year end, it becomes a topic pretty much everyone is talking about. But, do you panic every year when tax season rolls around? I know we have clients who do, even though they've been clients for years, right? So the average person does get a little concerned about, as a new tax season is coming upon them. So, hoping that, and what if you could actually walk away from that kind of stress-free, maybe with a tiny bit of confidence. So I'm hoping that's what we can do for you today. You take some tips out of this and make it a little bit of a more streamlined process for you as you move into that tax season. So we're going to talk about, your year-end checklist, the different record-keeping strategies, any proactive planning tools. We want to boost your cash flow and your profitability all year round. But again, we want to be kind of really seriously looking at as we come into that year end and in the beginning of the next year, right? Want to make sure we're taking advantage of things for the year we're in, but then we're also looking to the next year. Where are the things that we can take advantage of? So let's talk about why this matters. Well, like anything else that we talk about on here, poor planning is going to result in missed deductions. You're going to be rushing to get your filings done. There is nothing worse than scrambling to meet a deadline, a client scrambling, and we're in turn scrambling for them as well. It's not a pleasant experience for either side. And the more you rush to get a filing done, maybe the filing goes in late, you do have that probability of incurring penalties and interest and things like that. So you want to minimize the risk associated with any kind of penalties that you may incur for late filings, filings that aren't done correctly, aren't paid in a timely fashion, whatever it is, right? Again, poor planning is not, or no planning is definitely going to keep you behind the 8 ball to start. So we just want to get you to do some planning in advance to make sure that you're catching everything that you possibly can. You also want to be, again, back of the mind, no one wants this to be an issue for anyone, but you want to be audit ready. Just in case you do get chosen. You don't want to be scrambling. They'll be looking for your receipts, etc. should you get chosen or have to explain certain numbers. Being audit ready gives you peace of mind, and it will ultimately protect you in your business. If you, aren't quote unquote audit ready at all times, there's that chance that if you are chosen, it becomes harder to prove some of your deductions. You don't have your information still. You've lost some things. And then, of course, you lose out on deductions, which you actually truly were eligible for. You just didn't, keep yourself audit ready at all times. So again, we don't wish that upon anybody, but you want to keep that in the back of your mind. We want to be audit ready at all times. And proactive tax planning, right? Actually getting ahead of the curve will help you with your cash flow, will help you make better decisions in your business, and will ultimately help you improve your profitability in your business. But as I've mentioned before, waiting until December 27th to run out and buy a pickup truck to get yourself the depreciation for the tax savings isn't tax planning. If you need that asset, that's done in the planning stage at the beginning of your year, where you're looking to see what it is you want to do in your business and what tax savings options are available to you. So again, you want to do proactive tax planning. Now, when I talk about proactive tax planning, I mean at the end of a calendar year, we're actually planning for the next year. Why? Because we want to be able to ensure we can take advantage of any deductions, tax credits, anything we might be eligible for. And it's a lot easier to fund those things because in many cases, you are going to have to fund them. For example, a retirement. Retirement is an opportunity for you. Retirement expense is an opportunity for you to reduce your taxable income. There are, businesses side of retirement expense that you can deduct and so on and so forth. It's a lot easier for you to fund your retirement every single month through all of the 12 months instead of running out in that last month or in the last month before you file, and making all of your retirement contributions one big chunk at once. So again, you want to be proactive. You want to, what does that do? We're moving all of our payments throughout the calendar year. We are improving our cash flow. We're trying to flatten it out. And then ultimately, we're going to get some expense out of that so we can, potentially improve our taxable income, right? So again, this is why it matters. Like anything else we talk about on here, you want to do your planning in advance. You want to, with planning, you actually get to choose the options that you want versus the not planning, and you actually get dumped with one option, which may not be what you want. You actually get to choose, kind of pick your own adventure when you actually plan in advance. You're not stuck with what's left over. So let's talk a little bit about your year-end tax planning checklist. So what does that mean? You're going to review your P&L before year-end. Now, if you watch us often, you know that I talk about needing to review your profit and loss statement on a monthly basis. Now, or at the minimum on a quarterly basis. Now, if you are not that individual and you haven't done any of that at all, then you want to make sure that you have your accounting caught up, through November into early December, so that you at least have the opportunity to look at the first 11 months of the year and review where anything seems like it's off. You may have missed something. Again, here's your chance to go back and fix and clarify things before the year is too kind of dead and buried, right? Let's look at most of the year. So the only thing you have to do when you actually get to year end is ultimately look at that final month. But again, don't wait until the year is closed. Let's look at, all your activity through November into, somewhere in the middle of December. So it gives you the option to check to see if there's anything off and anything that you might need to adjust. So, let's look at all your major purchases. Can you accelerate any of those deductions, accelerate any of that depreciation? Now, if you've done proper planning, you've looked at that at the beginning of your calendar year when you've done your business planning. But there may have been some changes in the tax code. For example, we had recent changes in the middle of the year, which is not normally the case. So now here's the opportunity for you to look at and see what the adjustments to the code are. And are there ways for me to further accelerate, for example, depreciation on some of those major assets that we would have purchased during the year? So again, we've done our planning, but now here's an opportunity to maybe get some additional planning at year end. We did it at the beginning of the year to take advantage all year, but now some things have changed. So we want to look at the adjustments and see what's changed for us. So again, it's a constant planning. We're always staying ahead of it. You want to evaluate and look at any of your outstanding invoices. If you are a cash basis taxpayer, you're basically dependent upon dollars in, dollars out. Basic, like very simple way to look at it. Are you going to maybe chase some of those invoices that are due to you now to try and get that revenue in this year? Do you want to just wait until the latter part of December and maybe they pay you in early January and now it ends up in the next year? So now here's the opportunity for you to do a tiny bit of planning against this and trying to push that cash collection into the year that you would prefer it to be in. Maybe you want it in this year. So now you've gone to your customer, maybe you're giving them some sort of early payment terms, right? A minor discount for paying you early because you'd actually like the cash collection in this year. You'd prefer it versus next year because there's an anticipation of something specific next year. Right? So it gives you a little bit of time to look at it and see, what do we want to do? Do we want to keep it where we are? Do we want to try and push it into the next year? And then when it comes to estimated tax payments, whether you're a C Corp and you're making it on behalf of the Corp, or whether it's an individual who has a pass-through, has an S Corp or a partnership or an LLC, getting taxes in S Corp or a partnership, are the estimated tax payments up to date, or are they as up to date as they could be? If you are you looking to kind of see where your revenue has fallen and where you think your income is going to fall overall, where that tax liability might fall at year end. Again, have you calculated that? Have you made those estimates? Again, making those estimates throughout the year is what you typically should be doing. Again, you'll incur penalties and interest for not paying them or making underpayments on them. So again, right, little things. Did I make any estimates this year? Oh, I haven't made any. Maybe I should make an estimate before the close of the year, right? At least help you to get ahead of what that liability will be when you go to file in March or April or whenever you happen to file. Let's talk about record keeping, right? We always want to make sure that our record keeping keeps us audit ready at all times. So you don't want to just do your record keeping at year end. You really should be maintaining your records throughout the year. But maybe now is the opportunity for you to reevaluate how you've historically kept those records, maybe keeping them in a different fashion, some way for you to more easily access that information, right? So organize your receipts. We typically recommend that you organize them digitally. We're big proponents of that here. So you might have it in an app. You might have some sort of cloud storage. We typically, in this business here and with our clients, we happen to use an app, and that goes along with the client's QuickBooks file. And so those receipts typically sync out of the app into the QuickBooks. So now we have the receipts, in the app, it's in the client's QuickBooks file. So we have it in a couple of places. So again, what works for you? Does an app work for you? Does simple cloud storage work for you? Whatever it is, make sure that you're organizing your receipts. Again, I say digitally, that's probably the best way to do it. But if you still maintain your receipts in paper form, just be mindful that you have them organized in a way that you're going to be able to access them, just like in any kind of digital fashion. You want to be able to go back and grab them if you need them. You always want to keep your business expenses and your personal expenses separate, right? There should be no commingling. You should not be paying your personal mortgage out of your business account, your utilities for your home out of your business account. You should be paying yourself a reasonable compensation. Or if you are in a sole proprietorship, you're paying yourself, you're giving yourself your draws as an owner on a regular basis. The funds are drafting out of your business account, going into your personal account, and you're paying your personal expenses out of your personal account. Your mortgage, your car payments, your rent, your utilities, whatever it is, comes out of your personal accounts. You want to keep your finances separate. If you have an entity, you want to make sure you do that because you don't want to pierce the corporate veil. That challenges the overall legality of the overall legal structure that you have. Again, we're not going to talk about that here. But again, as I mentioned over and over on here, you need to make sure you keep your business and your personal expenses separate. You do not want to commingle them. You want to maintain your mileage logs, right? So if you are taking mileage, you want to make sure you retain a log of where that mileage number came from. That is one that honestly, if it does get chosen in an audit, if you do not have really good logs to track your mileage, it is a very easy way for the service to disallow that entire expense. So that's one I've seen, sadly. They were not able to fully document all of their mileage in an audit. They lost a good chunk of it because client could only really document about half of the overall miles that they took on the return. And so they had a really large adjustment because we couldn't prove all of the mileage because they just did not have a great mileage log. So that's a big one. Keep track of your mileage if you're taking actual miles driven on the return. Your payroll records. It is your responsibility, your legal responsibility to retain those payroll records. Typically, I believe it might be 3 years you're required to retain them. Don't quote me on that. But at the minimum, you need to ensure that you have all of your payroll records. That will not only keep you audit ready, but it's also compliant from a legal perspective in terms of having employees, being able to provide them with copies of their W-2s from prior years and so on and so forth. And if you have contracts, for those of you in construction, many of you are utilizing subcontractors in your businesses. So you're contracting with them to do certain projects. You want to ensure whatever contracts you have with your subs, you actually retain copies of and you keep in your records so that you are not only compliant from a legal perspective, but you're protecting yourself. And you always should be, we talk about monthly reviews, but if you're not doing monthly, you're at least doing quarterly reviews. because you do not want to get to year end and have to do the whole year all at once, because it becomes incredibly overwhelming. Or you're waiting until year end to aggregate all of your receipts together. It becomes overwhelming. I've heard on and off over the years the stories. I spent 2 whole weekends pulling all of my stuff together to do my tax return. That's painful. I know I wouldn't want to do that. So take the time throughout the year. It might be an hour a week that you need to do it. It's a lot easier to give yourself an hour a week to do this little thing, keep your receipts together, do your P&L, whatever it is, versus spending 2 or 3 long weekends pulling everything together just so you can do that tax return. So again, do everything in advance, do your reviews in advance so that you're not scrambling at the last minute. It's not fun for you as the taxpayer, and it is never fun for the preparer, especially on this side. It's not fun to have a client scrambling because we're typically scrambling with them at the same time. So let's talk about your proactive planning, right? It's not just for cash flow, but it's also going to be for profitability, right? So if you plan ahead, you can avoid, these large, unexpected tax bills, right? We'd like to know what we think our client's tax liability is going to be throughout the year. I don't want to do your tax return and find out you owe $50,000. Makes me very unpopular when I go to do your return. And it also probably, in most cases, makes the taxpayer's head want to explode. But if we're working throughout the year and we're calculating on a quarterly basis what we think that liability is going to be, we aren't surprised if you potentially might owe that at the end because we've known all along. Nobody wants to be surprised. You don't want to be surprised. And your preparer becomes very, very unpopular when they hand over very large tax surprises. So do some planning ahead so that you actually know what you think that tax liability might be at year end. With anything else, it always helps to put the money to the side, put your tax money in a cash reserve, put it, in a high yield savings account, right? Whatever works for you, but put those funds away throughout the year so you're not scrambling to come to the table with a large amount to get a tax return done and to get that tax return filed and compliant. No one wants to have to come up with $50,000 to pay a tax bill in February, March, or April. But if you've put a couple grand away every month throughout the year, that makes that lift far lighter, and you don't have to worry about, again, coming up with a large sum of money. And then again, what does it do? It puts a squeeze on your cash flow all at that one moment in time when you're trying to come up with a large sum of money. So again, do some planning in advance. Allocate some money into cash reserve throughout the year for that tax bill that you know is going to come up at year end. Because if you're profitable, you are going to have some level of tax bill at year end. You need, better visibility is going to give you not only confidence in what your tax liability is going to be, but any decisions you're making about growing your business moving forward. You don't want a large tax bill in March or April just as you're coming out of a winter season to, a large sum of cash goes out the door in order to pay that tax bill. And now that affects any future growth decisions you have. You may have had plans for growth for the year, but now right out of the gate, we're getting right out of that kind of seasonal gate. And, we've just spent a large sum of money, right? So again, you want to have that visibility. You want to know that you're not taking that all out of your cash flow at that moment in time. You've put the funds to the side throughout the year. It's not putting a pinch on anything you want to do in order to grow or improve your business. So what am I hoping that you took away from today, right? So what are some of your actionable takeaways? So first, make sure you're using a year-end checklist. You want to make sure if there are any gaps in your documentation, in anything that you've done throughout the year, you're doing that before you're going to file. Nobody wants to scramble when we go to file in order to find things or complete files and things like that. So again, get your checklist in November and start to put together the things that you're going to need and make sure you're going to get ahead of it. Number 2, digitize and categorize your receipts, your revenue, everything on a monthly basis. So we're big proponents of it here, doing your monthly financials, again, every month, so that there is no big surprise. You're staying ahead of it. You're keeping yourself audit ready. You're putting your receipts together in a digital format so that they're together in a monthly basis. Your financials are up to date. Everything is up to date. And again, if anybody wanted to look at anything at any point in time, for example, today, you could look at whatever the close of the prior month was, and your information is all there. You're not trying to do closings and bookkeeping and aggregation of receipts for 5 and 6 months prior, right? It's done. You're audit ready at all times. Number 3, review your cash flow now and make any plans for any estimates that you have to make, right? So if you haven't put any money to the side so far this year, let's look and see what your tax liability might be. If the year closed right now, what do you think your liability would be, right? Put that money to the side. Put that money to the side now. Work on putting that money to the side over the next 2, 3, 4 months before you know you're going to file, right? You know what the number is. You started to put the money to the side. You've put it in a cash reserve. Again, you are not crippling your cash flow when you go to file your tax return, because now you've pulled $50,000, $60,000, $70,000 for tax bills out of your cash flow. You've had it put to the side in a cash reserve all along. And again, you knew what the liability was going to be because you've known that number. And as you've worked with your CPA or your EA throughout the year, because you've had a conversation about that every time that you've met to review your financial information. And the last thing is the 4th, meet with your CPA or your EA or whomever you're using, do your planning, do your final plans before year end to ensure that any plans that you made at the beginning of the year actually came to fruition. You've done the things that you were supposed to do from a tax perspective. Because if you haven't, is there an opportunity now for you to grab any final deductions, credits, etc., that you might be eligible for just before you get to year end? Unfortunately, once the year is closed, while there are still some things you could potentially be eligible for, once you hit January and February and the year is closed, in some cases, it's harder to be eligible for credits and deductions if things, for example, have not been put in place prior to the close of the year. Are you taking advantage of retirement expense or to reduce your taxable income? If your actual retirement account is not set up before the close of the year, even though you may be able to fund it into the next year, well, if it's not actually set up before the close of the year, you can't take deductions for that year, right? So again, you don't want to wait until December 27th to realize you want to do these things. These are things that you've planned out through the year. But what do you want to do in December? You want to ensure that you've met with your CPA or your EA to ensure that you've done all the things that you had planned to do, and that the plan you actually scoped out at the beginning of the year has come to fruition, and if all of the pieces are going to fall into place the way that you planned on them. So you want to, again, make sure you are maximizing your tax strategies by ensuring that you've done them throughout the year and you're not scrambling to implement a plan in the last 2 weeks of December, because it becomes very hard for you in many cases to take advantage of all the things you could potentially be eligible for. So what's our recap here? Make sure you have the right checklist, the right record keeping that works for you. And then tax season is going to be a lot less stressful. We don't want you as the client to be stressed, because in turn, it ends up dumping the stress on us. And we don't want to be stressed any more than we are, because we're trying to meet all of these deadlines. So we want everybody to have a more pleasant tax season. We don't want everybody stressed to the nines every year. So again, let's do some proactive tax planning. You can get more savings. You can, improve your cash flow and make improve your profitability, and then ultimately just improve the overall strength of your business, right? So we have lives here every Friday. I look forward to seeing you here every week. If you have any questions, please drop them in the comments below. We'd love to hear from you. I look forward to seeing you here every week. Have a wonderful weekend, and we'll see you next week.